Think all FHA loans are the same? Think again. There's a little known version that can cover your entire down payment, your closing costs, with no strings attached, if you know how to play it right. But here's the problem. Most buyers, some lenders, don't understand how this program works. It's not your standard FHA loan. There are extra rules, stricter underwriting, and second lien details that could trip you up if you're not prepared. Miss one piece and your entire deal could fall apart. In this video, I'll walk you through exactly how the FHA first and second down payment assistant loan works, how it's different from your traditional FHA loan, and how to use it to buy a home with little or nothing out of pocket. If you're a first-time home buyer, this could be the edge that you've been looking for. So what exactly is the FHA first second down payment assistance program? Well, it's basically a standard FHA loan paired with a second lien that you can use for down payment assistance or closing costs. Now, something to understand here, this is not a grant. This is either a forgivable loan or a repayable loan, depending on which option you choose. The second lien is funded by a government-related entity, and it is available in most states, but only through specific lenders. Now, if you heard me earlier, I said it can be forgivable or it could be a repayable loan. So you're probably going, okay, well, what's the catch? Why wouldn't I always just choose the forgivable part? Why would I ever choose to repay it? Well, the primary reason is the differences in the two. One is going to come with a much higher payment than the other. But first, let's talk about the forgivable second. Now, this would go behind your loan. So typically when you buy a home, you come in with the down payment out of pocket, or maybe it comes in the form of a grant, or maybe a gift from your parents. But either way, you're bringing in that down payment. So in the case of a traditional FHA loan, the lender will finance 96.5% of the purchase price, which means you're coming in with that 3.5%. Well, the difference in this loan program is that the bank is financing the 96.5% on a first loan, and they're giving you a second loan behind it for that 3.5%, or in some cases 5%, depending on which option you choose. Now, in the case of the forgivable option, it's going to have a 0% interest rate. It's going to have no monthly payment, and it's going to be forgiven after 10 years of owning that loan. But here's the caveat. You still have to live in that home, and you couldn't have refinanced during that 10-year period of time. Now, when it comes to the repayable second, you have a choice between 3.5% or 5% assistance. But here's the catch. It's fully amortized over a 10-year period of time, and it's going to have an interest rate 2% above whatever the interest rate is on your first loan. So in the case that you're doing an FHA loan and you're using the repayable option, let's just say your interest rate is 7.25%. That means your interest rate on your second loan is going to be 9.25% on that 3.5% or 5% assistance. And lastly, it is going to require a monthly payment. So every single time you make your payment on your first mortgage, you're also going to have that payment on your second mortgage. Before we go any further, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. And if you want to stay updated on everything mortgage and real estate related, make sure you subscribe to the channel. Now, if you're like me, when you first saw this, you go, why would I ever consider the repayable option? Why wouldn't I just go with the forgivable option since it's 0% interest, there's no monthly payment, it's forgiven after a 10-year period of time? Well, the biggest reason is because it's going to have a much higher interest rate than that of the repayment option. So in order to have that second loan forgiven, you're going to have a much higher interest rate on your first mortgage than you would otherwise. So while this can be really, really confusing, what I want to do is take a minute here and talk about the key points, or the key differences, if you will, between your traditional FHA loan and this FHA first-second combo. Now, as we discussed earlier, your standard FHA loan requires a 3.5% down payment, but this program actually covers that down payment through a second lien. Another thing is standard FHA loans allow you to go down to a 580 credit score with that 3.5% down payment, whereas this program requires you to have at least a 600 credit score in order to qualify for that second loan. And now on top of that, if it requires a manual underwrite, with traditional FHA loans, you probably need somewhere around a 620 in order to get that loan approved. Well, with this program, you need at least a 660 credit score if the loan needs to be manually underwritten. In addition to that, standard FHA loans allow you to finance up to 4 units, whereas this program limits you to a max of 2. Another thing is traditional FHA loans allow you to go to a 47 front-end ratio and a 57 back-end ratio when it comes to your debt-to-income ratio. This program follows the exact same guidelines, which is one of the reasons that FHA loans are so great, because they're so lenient. They allow you to use more of your income towards debt than any other loan program out there, which essentially means using an FHA loan, you're going to qualify for more home than you are using any other loan program. Traditional FHA loans don't require any sort of home buyer education, whereas this program does require you to take a class. On top of that, there are no income limits, there are no income minimums, if you will, with either the traditional or this program. So you can make as little or as much income as you'd like and still qualify, assuming you meet the guidelines. But there are a couple of differences with the first-second combo that are different than traditional loans in the fact that you can't do buy downs with this first-second combo. So with a traditional FHA loan, you can buy down the interest rate. You can come in with additional money, you can get credits from the seller, and you can use that money in order to buy down your interest rate. With this particular program, there are no buy downs allowed. On top of that, they don't allow any non-occupant co-borrower. So anybody that's going on the loan needs to also be on title of the property. Now I realize I'm throwing a lot of information out there, and what I typically like to say in these videos is use this stuff for novelty purposes. Don't just take the guidelines, go over your scenario and say, yep, I'm good to go. I'm good to buy a home using this first-second combo. Rather, make sure you're talking to a mortgage professional, going through the actual process, getting pre-approved on this particular program, because it's going to be more strict. It's going to be more difficult to qualify for this program than it is FHA. So if you're having trouble with FHA already, you can't get approved for an FHA loan, then chances are you're not going to be able to get approved for this loan either. But if you're somebody that can qualify for FHA, you just don't have the down payment, you just don't have maybe the closing costs, you're not quite ready yet, but you can meet the other guidelines, then this is probably the right program for you. But what I would say is make sure you're speaking to somebody that understands the program, somebody that can guide you through the process. If you'd like to work with my team and I, we've put a link in the description of the video. We've helped hundreds of people here on YouTube, and we can help you too. But like I was saying a moment ago, if you're wondering who this program is for and who it isn't for, well, it's really for those buyers that can qualify for this loan, but they just have limited cash for a down payment or limited cash for closing costs. On top of that, maybe you're one of those high income earners that don't typically qualify for down payment assistance programs because you're over that threshold. Well, in that case, this could be a really good option for you. But with that said, if you go with the forgivable option where the second loan is taken care of, where you don't actually have to repay it, there's no monthly payments, 0% interest, you need to make sure you have a longer term time horizon. You need to be planning on owning that home for over 10 years. And also understand that if you ever plan to refinance within that 10-year period of time, you have to pay that loan off. They will not subordinate that loan. So it's going to have to be paid off anytime you refinance. But on the flip side, if you plan to keep it for 10 years, then that loan is forgivable. But like I said a moment ago, if you end up refinancing or selling that home prior to 10 years, then you actually have to repay that down payment assistance. Now, one of the questions I often get when talking about FHA is, well, what if I keep the home for a year and then I turn it into a rental? Can I do that? With this particular loan program, you're supposed to occupy that property as your primary home for at least 10 years. So if you plan on getting the home and turning it into a rental in a year, then that loan might not be forgivable. And that's one of the things that you need to discuss when you're going through that pre-approval process. That's one of the main reasons I want to make sure you're talking to a professional and somebody that understands these programs so they can walk you through that process just to make sure you understand all the nuances to determine whether or not this is the right loan program for you. For many people, this is not going to be the right loan program, especially if you have that money for a down payment, because it does come with higher interest rates. It does come with stricter guidelines. And if you don't want to have to deal with that, especially when it comes to repaying that loan. So if you're somebody that's planning on selling before then, refinancing before then, taking advantage of interest rates as they move down in the market, if you're planning on refinancing as better interest rates become available, then this option's probably not for you. But with that said, this FHA first-second combo is one of the few tools actually left where you can get into a home with almost no money out of pocket. But as we've discussed, it has to be done right. So what are your thoughts on this FHA program? Do you think taking the first-second combo is actually worth it by taking a higher interest rate? Do me a favor and let me know in the comments below. And if you're someone thinking about using this strategy, make sure you reach out using that link in the description of the video. Or maybe you're on the flip side just wondering if FHA is the right loan for you and you're wondering about the guidelines. Well, I filmed a video right here where you can check it out.